Ladies and gentlemen, welcome back to my channel where we unpack the biggest financial news of the day with a blend of sarcasm, sharp analysis, and that little extra punch the mainstream outlets won't give you. What are we talking about today? The stark and slippery slope the US economy is teetering on, all thanks to, drumroll please, our friends at the Federal Reserve and their infamous balance sheet shrinking plans. This, my dear viewers, is an economic cocktail that's becoming harder and harder to stomach. Reserve scarcity, liquidity crunches, and an economy almost as confused as a tourist without a map, it's all in the making, and guess what, it's not getting any better. Here's the headline: the US banking system reserves have fallen below $3 trillion, the lowest since 2020. Now, why is this such a big deal? Well, naturally, when bank reserves start tumbling, it hints at a deeper underlying issue. The Federal Reserve, our so-called economic stabilizer, has been shaving down its balance sheet, not so subtly rolling back its quantitative easing, QE, plans in favor of quantitative tightening, QT. In plain English, the Fed is sucking money out of the financial system, which is an almost surefire way to dampen liquidity and slow down the economy. So, Federal Reserve reserves fell by $326 billion in a single week leading up to January 1st, dipping the total reserves pool to $2.89 trillion. Folks, this is a watershed moment because that number hasn't been this low since October 2020. Think back to late 2020, a time when the world was grappling with the fallout of COVID-19, recovering from one of the largest economic recessions in modern history. Now, here we are in 2025, and once again, the reserves are tumbling. Deja vu, anyone? This massive weekly slide in reserves is largely attributed to banks paring down balance sheet-intensive activities, specifically, repurchase agreement transactions or repos, and stockpiling cash for regulatory purposes. Yep, banks are rushing to mop up liquidity, trying to look as squeaky clean as possible to the regulatory watchdogs, all while leaving the broader economy high and dry. But wait, there's more. The Fed isn't just passively letting reserves shrivel up. No, they're actively shrinking their balance sheet, on purpose. It's part of their ongoing quantitative tightening, QT, program which seeks to remove excess liquidity from the system. Or so the official line goes. Institutional players are already paying back loans under programs like the Bank Term Funding Program. Think of it as a loan cushion system created to stabilize banks during turbulent times, reducing the flow of available reserves even further. For years, economists applauded the Fed's extraordinary intervention during crises when they pumped money into the system. QE, by sheer volume, injected trillions of dollars into the economy and distorted markets in unprecedented ways. Bonds were scooped up from thin air like monopoly money, creating both artificial demand and backing up liquidity. So, what happens with tightening? It's pretty basic: liquidity dries up, borrowing becomes expensive, and sure enough, the stock and bond markets feel the pinch. Remember late 2019 when a similar sharp adjustment in central bank reserves triggered a market scare? The Fed had to step in again to stabilize the repo market after interest rates suddenly spiked. Are we on a similar course now? Let's chew on this nugget for a moment. A robust chunk of economic actors are now signaling their fears about reserve scarcity in intricate terms, debating the so-called minimum comfortable level for reserves. Wall Street strategists place the estimate between $3 trillion and $3.25 trillion, which, guess what, we're below now. The problem lies in what this balance shrinkage does to short-term market operations like repo markets, where companies swap assets back and forth to maintain liquidity. When reserves fall too low, liquidity snaps, interest rates spike, and overnight lending, which banks rely on to stay solvent, becomes tricky. The central bank has tried to ease some of this pressure. For example, the Fed adjusted interest rates on its reverse repo, RRP, facility, a tool where money is parked overnight in a safe haven at the central bank. This tweak was supposed to help keep short-term interest rates in check, pushing downward pressure on volatility. But let's face it, these moves are more of a bandage solution rather than a long-term fix. Alright, folks, let's rewind back to the last time we saw such a drastic tightening. It was September 2019, and things got real ugly, real fast. The Fed was slowly unwinding its bloated balance sheet then, just like now, and surprise, there was a sudden funding squeeze in the markets. You see, back in 2019, the level of reserves was scrapped down to the bone, pushing the repo market into a frenzy, a virtual liquidity desert. The Federal Reserve had actually underestimated the market's hunger for cash, causing repo rates to explode from 2% to 10% in just a span of hours. So there's precedence here for catastrophic missteps if the delicate dance of QT goes wrong. Fast forward to today and there's a growing debate around how long the Fed can keep trimming the fat off its balance sheet before memories of that 2019 liquidity freakout come creeping back. It's becoming a legitimate concern that keeps policymakers up at night, including Jerome Powell, I'm sure. Now, to throw another wrench into the works, the debt ceiling is back in the headlines too. That's right, folks. The characteristic political gridlock we've come to expect over this antiquated debt ceiling is poised to complicate the Fed's decisions even further. As the Treasury scrambles to stay under this arbitrary cap, it dishes out liquidity injections and liquidity drying measures. This makes it excruciatingly hard for the Fed to assess what is real liquidity versus what's just temporary smoke and mirrors. Overall, let me just echo the thoughts of 2/3 of the financial community who, by the latest New York Fed surveys, believe QT will finally grind to a halt sometime in the first or second quarter of 2025. The market participants are already sounding the alarm. They see the inevitable pain that comes from excessive tightening amid market fragility. And let's not forget, this isn't just an esoteric discussion for Wall Street insiders to hash out in their private meetings. The consequences of these liquidity issues bleed into the real economy, to people like you, your businesses, your mortgages, your car loans. If reserves get too scarce, borrowing costs will surge, and the ripple effects will be felt on Main Street. It means the credit tightens up for that small business loan. It can mean layoffs or slowed growth for your company because cash isn't accessible. Every percentage point uptick in interest rates sends shockwaves through consumer spending and business investment. Moreover, slower or halted lending chokes off economic expansion, putting additional downward pressure on consumer confidence. With tighter financial conditions, inflation, already a hot-button issue in America, could see more volatility, moving us from concerns of whether consumer price inflation is falling fast enough to whether businesses are even able to survive in this tightened regime. We're in a quandary, folks. Policymakers are essentially playing a game of chicken with liquidity right now. How deep can they shrink before it becomes 2019 all over again? How will inflation and employment be affected as reserve scarcity squeezes like a slowly tightening vice? What makes this all the more troubling are the mixed signals. Many financial giants, Goldman Sachs, JP Morgan, and the like, are watching warily over what happens next. Will the Fed blink first and relax its balance sheet agenda? Or does shrinking continue until the fragile illusion of stability breaks? In conclusion, brace yourselves, because 2025 has just begun, and we're already seeing the pressures mount. We got less than $3 trillion in reserves on deck and a QT program that's slowly but steadily deflating our financial balloon. Add in the storm brewing over the debt ceiling, and we might just see some fireworks. But you want my prediction? Sooner or later, we're going to hit that wall of liquidity starvation, and the consequences won't be light. The Fed will have no choice but to pivot back to easing, yes, printing more money, because if they don't, liquidity shortages could tip the economic scales back into full-blown recession territory. So, as always, don't forget to grab your popcorn, keep an eye on those interest rates, and most importantly, keep your wallet safe, because the next few quarters could be a wild ride. Thanks for tuning in, folks. Remember to like, subscribe, and hit that notification bell for more no-nonsense economic insights that actually cut through the noise. Until next time, stay sharp.